Good morning, I'm Lauren Hayes for the Finance News Network. Stocks fell on Wednesday after Federal Reserve Chair Jerome Powell said inflation was still too high and therefore the central bank has further to go in raising interest rates. The Fed implemented another 75 basis points rate increase Wednesday afternoon, and Powell said in a press conference that its inflation fight was far from done. Powell commented, "We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected." Powell also highlighted a still tight labour market and a resilient consumer underpinned by strong household balance sheets. Markets struggled to interpret the central bank's stance, while stocks jumping after the statement was released, then sinking after Powell warned in his press conference that rates would top out at a higher terminal level. The Dow Jones Industrial Average fell 1.6%, eating away at its significant October rebound, and after Wednesday's losses, the 30 stock index is down now more than 11% for the year. The S&P 500 dropped 2.5% and the Nasdaq Composite tumbled 3.4%. Behind the inflationary numbers is a story of rising prices, not rising wages. Today's price inflation is more a product of profits than wages. Broad-based inflation is normally a labour cost problem. The rule of thumb is that labour costs are around 70% of the price of a developed economy's consumer prices. In the US, wages have been rising, but prices have been rising faster. So real wage growth is catastrophically negative. This is far removed from the 1970s-style wage price spiral that drove inflation decades ago. This is the current inflation story. Companies have passed higher costs on to customers, but they've also taken advantage of circumstances to expand profit margins. Those circumstances include strong post-pandemic household balance sheets and increased borrowing to offset the sorry state of real wages. The resulting resilience in demand has given companies the confidence to raise prices faster than costs. But any softening of demand can quickly turn pricing power on its head. The slowing demand for consumer durable goods this year turned the fastest ever inflation in prices for those products into the most dramatic deflation since data started being collected on them in the 1950s. Companies, it appears, are walking a tightrope when it comes to consumer demand and pricing. Across the sectors, there was no leadership. The only area of strength was with Chinese-related companies, which extended their rally on hopes of a reversal of China's zero-COVID policy. On the currency front, one Australian dollar is weaker compared to the US dollar yesterday, buying 63.58 US cents. Now to commodities. The iron ore futures are pointing to a 0.8% gain. Gold fell 0.7%. Silver dropped 2.2%. Copper lost almost 1%, and oil added almost 1%. The SPI futures are pointing to a 1.6% fall today. I'm Lauren Hayes. Have a great day.